Welcome back to Charged Alpha, the S&P 500 stock encyclopedia. I'm Hudson Thomas, and today we're covering the single largest manager of money on planet Earth. Episode 124, BlackRock, ticker BLK.
$11.6 trillion in assets under management. Hudson, that is not a typo. To put that in perspective, the entire U.S. GDP is around $29 trillion. BlackRock manages the equivalent of 40% of the U.S. economy.
And here's what makes it wild. They built all of that starting with 8 people in a single room in 1988. From a studio apartment to controlling more capital than any institution in human history. That is a 38-year run that belongs in the history books.
And yet the stock is sitting 18% below its 52-week high as we record this. Q1 2026 earnings dropping tomorrow morning. So the timing on this one is not accidental.
No, it is not. Let's get into it. BlackRock, Inc., founded in 1988, headquartered at 50 Hudson Yards in New York City. 22,600 employees. Trades on the NYSE under BLK. Current price right around $1,000 a share.
The company operates across several major business lines. First, iShares, the world's largest ETF platform. When someone buys an S&P 500 index fund at a discount broker, there's a very good chance it's a BlackRock product. Second, active equity and fixed income funds. Third, multi-asset solutions, including target date retirement funds, and increasingly, alternatives, infrastructure, private equity, and credit.
The alternatives pivot is a big deal. In January of this year, BlackRock closed its $12.5 billion acquisition of Global Infrastructure Partners, GIP, which manages $170 billion in infrastructure assets. Airports, ports, pipelines, data centers, real assets. That deal fundamentally changes what BlackRock is.
They also acquired Preqin, the leading database for alternative investments, for $3.2 billion last year, and HPS Investment Partners for roughly $12 billion, which adds a massive direct lending and credit platform. In about 18 months, BlackRock went from being primarily a public markets firm to having a serious alternatives franchise.
And then there's Aladdin. The Aladdin platform is BlackRock's risk management operating system. Over 200 financial institutions around the world use Aladdin to manage their portfolios. That includes pension funds, insurance companies, sovereign wealth funds. It's a recurring technology business sitting inside an asset manager.
Why now is straightforward. Institutions globally are shifting their target allocations away from 60-40 stock bond portfolios toward models that include 15 to 30% alternatives. BlackRock just built the infrastructure to capture that shift at scale. They are positioned at exactly the right place, at exactly the right time.
Competitive moat, 3 layers. iShares gives you structural passive inflows that are close to automatic. Aladdin creates extraordinary switching costs. Nobody rips out their risk management platform lightly. And pure scale, 11.6 trillion in AUM, means the fees are massive even at extremely low basis points. Larry Fink, Lawrence Douglas Fink, born 1952 in Van Nuys, California. UCLA for his undergraduate degree in political science, then a UCLA MBA in real estate finance. He started his career at First Boston in the 1970s, where he helped pioneer the mortgage-backed securities market before it was mainstream.
He co-founded BlackRock in 1988, along with 7 partners, including Rob Capito, who is still president of the company today. The founding capital, $5 million, came from Blackstone's Pete Peterson and Steve Schwartzman, which is where the firm's original name came from. They moved out and rebranded, but the origin story is a fun footnote.
Fink has been CEO for 38 years. He's widely regarded as one of the most influential voices in global finance. His annual letter to CEOs became must-reading across boardrooms worldwide. He's pushed hard on stakeholder capitalism and long-termism for years, though he's dialed back some of the ESG language more recently, given the political blowback.
His track record is extraordinary. Under his leadership, BlackRock went from nothing to the largest asset manager in history. He also managed through the 2008 financial crisis in a way that actually increased BlackRock's influence. The firm was called in by the Federal Reserve to help manage troubled assets, including Bear Stearns' portfolio. That cemented the firm's reputation as the go-to for systemic risk situations. Let me walk through the financials. Starting with valuation, BlackRock trades at 28 times trailing 12-month GAAP earnings. Forward PE is 18.9 times, meaningfully lower because analysts expect adjusted earnings to accelerate sharply in 2026. Price to book is 2.78. EV to EBITDA is around 20 times.
The GAAP versus adjusted GAAP here is notable, right?
Very much so. GAAP net income actually declined 12.8% in 2025 compared to 2024, but that's almost entirely attributable to acquisition-related amortization and integration costs from the GIPE, Prekin, and HPS deals. The Q4 2025 adjusted earnings per share was $13.16 versus an estimate of $12.24, a solid beat.
Revenue tells a different story.
Completely different. Revenue grew 18.7% in fiscal 2025, from $20.4 billion in 2024 to $24.2 billion last year. The quarterly progression was $5.3 billion, $5.4 billion, $6.5 billion, and $7 billion in Q4. That acceleration matters.
And margins?
Gross margin is 50.5%, healthy for an asset manager. Operating margin is 29.1%. Net margin at 22.9% is solid, but compressed from FY 2024's 31%, again reflecting acquisition integration costs that should roll off over the next 12 to 18 months. Free cash flow is where it gets interesting in a less flattering way. TTM free cash flow is $3.6 billion. That's low relative to the earnings power of this firm. Q1 2025 actually printed negative free cash flow of negative $1.2 billion because of annual bonus payouts, a seasonal quirk at financial firms. If you annualize the Q2 through Q4 run rate, you're looking at more like $4.8 to $5 billion in normalized free cash flow.
Balance sheet?
Very manageable. Total debt is $15 billion against $11.5 billion in cash, so net debt is only $3.5 billion. Debt to EBITDA is just 0.4 times. And the current ratio is 70. BlackRock essentially has no short-term liquidity risk. The balance sheet is a strength here, especially given how much they just spent on acquisitions. On dividends, yield of 2.1%, paying $21.36 per share annually. 22 consecutive years of dividends. The 5-year dividend CAGR is 9.8%, well above inflation. Payout ratio of 60% is sustainable against current free cash flow. Overall, BlackRock's financial health is solid. Revenue accelerating sharply, balance sheet clean, dividends growing, acquisition costs temporarily weighing on GAAP metrics, but the underlying business is compounding.
Wall Street is broadly constructive on BLK. The consensus is overweight, with about 18 analysts covering the name. Median price target in the vicinity of $11.15, which is roughly 11% upside from current levels. Target range is wide, roughly $980 on the low end to around $1,200 on the high end.
Recent analyst activity has been supportive. Barclays and Morgan Stanley maintained overweight ratings in early April. Goldman maintained buy. UBS actually upgraded from neutral to buy in late February, notable because UBS is typically more conservative on large financial firms. KBW maintained outperform.
Any downgrades?
TD Cowen moved to hold in January, citing valuation concerns after a strong run and integration execution risk. That's a reasonable bear case, but one hold against a sea of overweights and buys tells you where the consensus sits.
In Q4 2025 earnings.
Clean quarter. Adjusted EPS $13.16, beat the $12.24 consensus. Revenue $7 billion, beat the $6.76 billion estimate. Organic asset growth was strong. The company didn't give specific numerical guidance for 2026, typical for asset managers whose revenue is inherently market dependent, but the commentary on AUM flows was positive.
Let's do the bull case first. I'll take it. The bull case rests on a simple thesis. BlackRock is the only firm on earth that can offer institutional clients a truly integrated platform spanning public markets, private markets, risk analytics, and data. Nobody else has that. The GIP, HPS, and Prekin acquisitions didn't just add AUM. They created a flywheel. Institutions allocating to alternatives want the same firm managing their public and private books. BlackRock is becoming the operating system for institutional capital. Add to that the Aladdin expansion into private markets data. Fink's stated ambition to grow technology revenue significantly. And you have a story where the multiple should expand as BlackRock starts trading more like a financial technology platform than a traditional asset manager.
The bear case is harder to dismiss than it looks. The alternatives business is new. BlackRock built iShares and Aladdin over decades. GIP and HPS are being integrated simultaneously in a high-rate, volatile market environment. Cultural integration at financial firms is notoriously difficult. If key investment professionals at GIP or HPS leave, which happens in every large acquisition, the acquired AUM walks with them. The second bear concern is fee rate compression. As more and more money flows into zero-fee passive products, which BlackRock itself sells, the blended fee rate across the entire platform inches down every year. They need to keep acquiring higher-fee alternatives businesses just to offset the structural fee headwind in the core business. That is a perpetual treadmill.
Let's benchmark BlackRock against its closest peers. We'll look at Apollo Global, Blackstone, and KKR.
On a PE basis, BlackRock at 28 times is actually the cheapest of the group. Blackstone trades around 30 times. KKR is up around 32 times. Apollo is slightly cheaper at 22 times, but growing faster. So BLK is not expensive relative to its alternatives peers.
Revenue growth?
This is where it gets interesting. Apollo grew revenue around 28% last year, Blackstone around 20%, KKR around 22%. BlackRock at 18.7% is in the same ballpark, but with far more AUM scale. Growing 18% on a $24 billion revenue base is a different achievement than growing 20% on a much smaller base. BlackRock's net margin of 23% is actually competitive or superior to most of its alternatives peers, which are more exposed to carried interest timing and volatile performance fees. BlackRock's management fee revenue is stickier and more predictable. That stability commands some premium. Quick check on the options market, put-call ratio around 0.88, a mildly bullish skew, implied volatility in the 44th percentile, slightly elevated heading into earnings tomorrow, call open interest clusters at the 1050 and 1100 strike levels, put open interest protecting the 960 and 920 levels.
Translation for listeners. The options market is positioning for moderate upside with the earnings catalyst tomorrow, and there's a reasonable floor of put support if the quarter disappoints. Not an extreme setup either way. And as always, options activity is data, not a recommendation to trade options. On the insider front, activity over the last 90 days has been routine. No large open market buys or sells. Most transactions appear to be prearranged 10b5-1 plan sales, the standard mechanism executives use for tax planning and diversification. There's nothing that reads as a strong signal in either direction heading into earnings.
3 risks to stay close to. First, alternatives integration execution. Watch for talent departures at GIP, HPS, and Prekin in the quarterly earnings commentary. Management retention metrics matter. Second, AUM net flows. In any given quarter, a large institutional redemption from a sovereign wealth fund or pension can move the headline AUM number dramatically. Third, the regulatory environment. BlackRock's scale makes it a perennial target for potential designation as a systemically important financial institution, which would bring higher capital requirements.
Key metric to watch going forward: organic base fee growth rate. That's the cleanest measure of whether BlackRock is winning new client relationships versus just rising with the market tide. Let's land this. BlackRock is a compounding machine that just went through its biggest strategic transformation since Larry Fink co-founded the firm. The iShares franchise and Aladdin platform have already proven their durability. The question now is whether the alternatives build, GIP, HPS, Prekin, will add a third durable revenue stream or become an expensive distraction.
The financial health verdict is solid. Balance sheet is clean. Dividends are growing at nearly 10% per year. Revenue accelerated 18.7% in 2025. And the forward PE of 18.9 times against a revenue growth rate of similar magnitude makes this look reasonably valued relative to the alternatives peer group.
The bears are right that fee compression is structural and integration is hard. The bulls are right that nobody else has the platform BlackRock is building. That tension is the whole stock story. We'll close with a quote from Larry Fink himself. He said this about the ethos behind everything BlackRock has built: the democratization of investing, bringing sophisticated portfolio management to every person, not just the privileged few, is the defining opportunity of our generation.
And that philosophy is at the core of how they built iShares into what it is. Whether the alternatives push extends that mission or diverges from it is worth watching.
That's going to do it for episode 124 of Charged Alpha. And hey, if you want to run the same research workflow we use to build these episodes, everything's free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, commodities. No sign-up, no paywall. The same data that powers this show is sitting there waiting for you to run your own screens. Check it out. Until then, I'm Hudson Thomas.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall